Albert is, and Martell is coming in just now.
Albert, you want to lead today?
Did he hear you?
I don't know.
He was on just a minute ago. I don't know what.
He's muted.
Oh, is that it?
Mhm.
Is Christina?
I'll go ahead and start whenever you're ready.
Yeah.
Okay, hang on just 1 second. I think we're good. Okay. Yep. So we are live. So we are ready to go.
Thanks, everyone, for joining today. I'd like to call today's meeting to order for October 20th, 2022, the Investment Committee meeting. Sue, can you take a roll call vote, please?
Angela Banks, Christina Bennett,
Present.
Lewis Cross,
Present.
Sheila Goodwin, Donna Jones, Yvette Levy, Martell Mann,
Present.
Bobby Richardson, Albert Sanders,
Present.
Justin Stein, and Doris Walker.
Present.
Okay, so we have 5, so we do have a quorum to get started.
Great. Thanks, everyone. At this moment, I'd like to turn it over to ANCO, our consultants, to lead today's meeting and discussion with our presenters.
Okay, Jeff, you want to, since you.
Sure. Great.
Yes.
Thank you all from UBS from being here. And if you want to do some brief introductions, but just as a matter of format, we've allotted you an hour of time, and hoping that you can spend 30 minutes of that on general real estate industry education and other factors. This group has continuing education requirements, and in order for them to be able to count some time at that, it has to be sort of high level asset class in nature. So that would be preferable. And then if you want, you can spend the other 30 minutes talking about the firm in general and update specifically on the portfolio, strategy, operations, people, and anything else that would be of pertinence to this group. So with that, I will hand it over to whoever's leading on the UBS side, and then certainly we will all jump in if we have questions. So take it away.
Great. Thank you, Jeff. This is David Lawson with UBS, and I have a number of other colleagues who are joining me for the call. We're delighted to have the opportunity to spend some time with you and the public school system in St. Louis. I guess first of all, let me, if I may, take a kind of a head count of our participants who are on the call. Jason Lewis, are you here?
David, I'm on audio. I was not able to do video, but I'm here. Thanks
All
for having
right.
me.
Chris Clayton, are you here?
Yes, I'm here on the video.
How about Francis?
Yes, I'm on video.
Great. And Tom, I saw you earlier, so it looks like our whole team is here. Our meeting, our order of presentation is going to be a little bit chopped up in that we wanted to be sure and give Jason Lewis the opportunity to talk about TPF, which is one of the 2 funds you're invested in. Normally, we would have some of the market and firm discussions before we got into the fund discussions. But Jason has a kind of limited window that he's going to be able to be on the call. He's one of the portfolio managers with TPF. So we're going to let him go ahead and do about 15 minutes on TPF. It is a little bit backwards to start with the fund, but we're going to do that. But before I turn it over to Jason, I'm just going to make a couple of quick comments. We've had a very long-standing relationship with the public school retirement system in St. Louis. You invested initially in the Full Property Income Fund back in 1984, and your investment in that fund has grown appreciably over the years. You've taken several kind of withdrawals and redemptions, but still have a substantial balance. And then also in 2004, you invested in TPF, and similarly, have been a long-term investor there, have made a big substantial investment initially, and over the years have taken some redemptions and distributions, but still have a substantial balance. So it's been a long-term relationship. We really do appreciate that. I had the opportunity to spend some time with Susan earlier this year, kind of getting her up to speed on the two funds, and then we're glad to be able to do it to a wider audience. So with that having been said, I'm going to turn it over to Jason. He's going to talk about TPF, then move over and talk a little bit about the real estate market in general, with Francis leading that discussion. So, and then move on to the other two topics. So I'm not going to take up any more of Jason's time. Jason, please jump in.
Okay, thanks, David. Can you hear me okay?
Yes.
Loud and clear.
Okay, great. So thanks to everyone for having us on. Sorry, I couldn't be live on video. So I'll push my 15-minute alarm clock now. And hopefully we can give you some education also through our overview of these fund strategies and performance to date. So Trumbull Property Fund is one of the oldest funds in the Odyssey Index, over 40 plus years of investment track record, an $18.4 billion fund in terms of gross assets today. We've got about 155 investments and 439 investors. So a very, very large fund with a pretty deep track record. So I'll turn now just to keep you, I'm on page 36.
Jason, David here. It might be helpful if you would give them some guidance on, and maybe you don't have a copy of the presentation.
Yeah, I think slide 33 is where it starts with TPF.
Okay, we're just getting the spot up with it. So 33 is kind of a cameo shot of several properties, and then the next page has the Trumbull Property Fund highlights that I think you were starting to reference.
Yep. Okay, sorry, I have a previous version of the presentation here. So I'd say page 34, right, is our Trumbull Property Fund highlights? It's numbered page 35 and presentation page 35. Okay, yeah, I was referencing the.
Right.
Okay, so I'll reference the numbered page 36 now for us to all kind of get on the same page with and kind of give an introduction to our investment, our portfolio teams. Is everyone with me on that page?
Got it.
Okay. Great. So again, my name is Jason Lewis. I've got about 16 years of experience in the business as a portfolio manager in various other functional areas. I joined in January of last year. I focus on what we call the diversified core sub-portfolio of TPF. So that's the majority of the fund that we call our quote unquote keeper portfolio. And I'll explain a little bit about how that's a kind of a nuanced title in a little bit. Mario Machuro, he's the portfolio manager for what we would call our non-strategic asset pool. So a sub-portfolio of originally about $4 billion in investments that we set aside as non-strategic assets that we would sell in the course of a couple years. And that started when we repositioned the fund in 2020. And then Paul Canning at the top on the left column is our senior portfolio manager. And he's been with the firm for 31 plus years and has about 42 years of experience. So some of you may know Paul already. We've added kind of 4 new entrants to the firm. Most recently, Ming Chen on the far right. She is the head of performance measurement. We're excited to have Ming from the public equity side of the business. She has a very long experience in attribution. Daniel Bothwell just joined the firm from last year from an operating partner. and Chris Deering actually has 7 years of asset management experience with the firm. And then CJ McBeharu, who focuses on a lot of our technology applications and working with other functional areas of our firm to get more transparency out of our data to include that in strategic decision making. Let's move to the next slide. I want to give a brief snapshot of how our asset management team has evolved. So with Tiffany Gerlone joining as the head of asset management earlier this year, one of the great initiatives that she kind of first set in place was realigning our asset management team by strategy, and then secondarily by sector. So what the benefit to me as a portfolio manager for TPF, we have a dedicated team of asset managers solely focused on TPF assets, and including a head of asset management, Brent Hall, that really makes it more effective in executing kind of top-down portfolio strategies down to the asset level. And we have sector heads in the asset management role, as you can see here as well. And that's really has been a big welcome addition to kind of how we're able to operate within and with our other functional areas of the firm. So let's move down to the next slide. I'll give a brief overview of strategy where we're on slide number 38. So Trumbull Property Fund has historically been a quote unquote low risk investment strategy. We would continue to define ourselves that way, but how we define low risk has evolved a little bit. In terms of leverage, we're at about 18.1% leverage, and that's about 400 basis points below the benchmark average. And we plan on increasing that over time, but given the current debt capital markets environment, we're going to stay flat at that level, and I think that'll be a competitive advantage for us. In terms of investment strategy, we have evolved to be a lot more focused on what we would consider low CapEx sectors. So sectors of the real estate industry that require less CapEx and generating a better risk-adjusted return. And that includes apartments, industrial, and self-storage assets. And we'll, again, get into a little bit more of that as I go through the presentation here. Let's keep it moving down to page 39. Page number 39. So what this page does a good job of is communicating what our low capex strategy really means and how it's our historical track records demonstrates that the benefits of being in these sectors. So the chart on the right on the x-axis shows the amount of capex spent as a percentage of NOI. So the further to the right you are, the more CapEx is spent in order to generate returns. And the y-axis is the actual level of total return over the last 5-year period. And as you can see, the top left chart means you're spending less money, less CapEx to get higher returns. And the bottom right is that you're spending more in CapEx and getting lower returns. So kind of the sweet spot is the top left, and that's industrial storage, self-storage, and apartments, and kind of the penalty box is the bottom right. And what you'll notice as we go through the presentation, we've more than doubled our exposure to industrial over the last 4 years and increased our exposure to multifamily by about 1,000 basis points. So our portfolio continues to evolve to support our low CapEx strategy. Let's move down to the next page. We're on slide 40. And this page discusses the non-strategic asset disposition forecast. So to take you a little bit, to rewind the tape a bit here, in 2020, the firm set out on a repositioning of the fund of TPF. And as part of this reposition, we split the fund into 2 separate funds, one of which was called the non-strategic asset pool. So when it was set in June of 2020, that comprised $4 billion of assets that we planned on disposing of over the course of the following 3 years. That would help us pay down redemption pool and also help us get close to our market and sector allocations. And I'm happy to communicate that to date, we are about 74% through our dispositions of that pool. So we're on track and we are projected to accomplish a full dissolution of that portfolio by the end of 2023. We have had some disruption in the capital markets that have caused a little bit of headwinds in the sales market, but we have a very refined strategy for every asset that remains in that pool, and we are expecting a 2022 and 2023 disposition for remaining assets in that fund. So I will say that in addition to the sales that we've executed in the NSA, we've also been very active in the diversified core portfolio or our keeper portfolio. So if you kind of, we'll talk a little bit more about the diversified core portfolio in a bit, but we executed about $1.2 billion of dispositions in 2021, and we're continuously being active on the acquisition and disposition side of the diversified core portfolio to reach our market allocation and sector allocation targets.
So,
So
Jason,
let me-
David, one clarification is when you started talking about the non-strategic asset, you said we split it into, the overall fund into two funds. Just to be clear, TPF is one fund, and there are two buckets within that fund, and the non-strategic assets are one of the two buckets.
Yep.
And so, just if you can clarify that even further, is the system exposed to both?
Yes. TPF is one fund, and we have split the assets within the fund into two buckets. All of the investors in the fund, own a slice of each of the two buckets. And the non-strategic asset bucket, as Jason was mentioning, is being sold off and has been substantially sold off. And, all the investors are exposed to both buckets, but the non-strategic asset bucket is shrinking, has shrunk rather substantially. And, we still have a ways to go, but, we can certainly, see the end point, and it's not that far off. Sorry, Jason, go ahead.
Yeah, just and on that point, as we move to slide 41, this represents kind of our performance against our relative benchmark over various time horizons. We, in terms of accomplishments over the last 2 years, you can't see first quarter of this year, but we've been tracking very close to benchmark performance on a trailing 12-year basis over the last 2 quarters. As of the first quarter of 2022, we actually outperformed the benchmark. And the second quarter of 2022, we were also close behind the benchmark. If you look at our 1-year performance as of 2Q, that's the third group of charts from the left-hand side. 24.65% return is our strongest level of absolute return in the history of the fund. And though you can see there is a differential between our benchmark, and we'll talk a little bit about where that's coming from. But let me move you to the next slide.
Sorry, do you have any indication at this point how the third quarter looks?
Yeah. So, sorry, David, I'm not sure if you have the Odyssey returns. Do you happen to have the Odyssey returns handy? I actually don't with me, but the quarterly performance for the fund, the total quarterly performance for the fund, I believe, was a positive 0.02%. So our income return was balanced by slight negative appreciation on the fund. And if I'm not mistaken, the Odyssey return for the quarter was a 0.2%, but I'll have to get back with you the exact Odyssey number for the quarter.
Yeah, and Jason, I don't have those figures here in front of me, but my recollection is that what I had heard is that the fund versus Odyssey for the most recent quarter, there's about a 50 basis point shortfall on the fund side. And in the grand scheme of things, 50 basis points is not that big a spread.
Yeah. So, yeah, I think you're right, Dave. I think the number for Odyssey was closer to 0.5%, and we were at 0.02%. So there goes that 50 basis point spread.
that good, Jeff?
Okay, so
Great, thank you.
okay, let me move you to slide 42. So, this gives you just a little bit of color into our performance of our direct real estate over the course of the 3-year period. So we were talking about the NSA and the diversified core being part of the same portfolio. And I think what is interesting about this chart and what it shows is that we've been narrowing our performance to the benchmark over the course of the last 3 years. As you can see, TPF is the bottom gray line and Odyssey is the blue line. And this is the trailing 1-year performance at each iterative quarterly period. So in September of 2019, we were about 500 basis points below the benchmark in terms of the performance of our direct unlevered property level performance of our direct real estate. And then if you look on the far right, March and June of 2022, we're right on par with the benchmark. So we have been kind of at benchmark performance levels over the last 2 quarters, despite a lot of the transaction or sales activity over the last couple of years. And that has been, selling assets that have been some of the bigger performers, biggest underperformers of the fund in recent years.
So, Jason, you might want to briefly touch on what ACOE is and why we're using that.
Sure. So sorry, I just lost place here. The ACOE is the benchmark. It's a subset. It's comprised of a subset of Odyssey. So Odyssey is comprised of 24 open-end fund vehicles. ACOE is an MSCI benchmark. Odyssey is NCREIF. ACOE is an MSCI created benchmark, and it is a subset of those 24. So it's basically 22 of the 24 funds. So if you look closely at the performance of the 2 fund vehicles, they pretty much mirror each other. I think MSCI ACOE represents about 93-94% of the total Odyssey fund. So we use ACOE because we utilize MSCI to conduct our attribution to look at our performance by property type, and then we use ACOE for the purpose because we don't have the ability to use Odyssey in that regard. So that's the difference between the 2 benchmarks.
Do you know offhand what are the 2 funds that are excluded relative to Odyssey?
I knew you'd ask me that question. I don't know, but I can follow up with you. I know recently PA Realty was one of the assets that wasn't included in ACOE, and they just included themselves in ACOE. Goldman Sachs had an open-end fund vehicle that was also not included, but they are no longer in Odyssey. So the difference was about 4 funds, and now it's only 2. But I'll have to get you those specifics.
Yeah, Jeff, I wrote that down. I'll look into it and get back to you with that information. Good question.
Thanks.
Okay, so I will just let me just cover one more slide here. I know I'm out of time. My alarm clock went off here. I'm 16 minutes in, but I will cover slide number 43 next. And if you're with me, this slide looks at our unlevered performance of our diversified core vehicle. So again, our diversified core represents the majority of TPF, and what we're showing here is annualized returns from July of 2020 when we bifurcated the funds until Q2 of 2022. So it represents 24 months, 8 quarters of performance. And the reason that we're showing this is, we mentioned the NSA is 76% liquidated. Once that is done, the performance of TPF will look like the diversified core portfolio. So here you can see kind of on an annualized basis, TPF has outperformed the benchmark 17.1% versus the benchmark of 14.9%, where the blue bar on the far left-hand side against the gray bar in the far left chart. About 220 basis points of outperformance since we bifurcated the funds. And what the right side of this chart indicates is looking at our unlevered direct real estate performance by property sector. this kind of gives you a little bit of color of how we're doing in each sector, and I'll walk through these very quickly instead of going through all the detail in subsequent slides. So if you look at our apartment performance at 17.3%, we outperformed the benchmark by about 270 basis points. We have 38% of our portfolio in multifamily, and that's about 1,000 basis points overweight to the benchmark. So our overweight to this sector and outperformance of the sector really has boded well for overall performance. I mean, multifamily has been a bellwether of the TPF portfolio, and we believe, given supply-demand fundamentals, it'll continue to be a big driver of outperformance for us going forward. We saw outperformance in all subsectors, high-rise, mid-rise, and low-rise. We started to see a recovery in kind of urban high-density product and a continued strength in rent growth in our suburban low-density product. Moving to industrial, 32.2% on an annualized basis versus the benchmark of 34.7. And you can clearly that's a huge absolute return number, right? 32.2% is just a big number because industrial had a great year, but we're still slightly behind the benchmark. And why is that? Well, we uncovered 2 years ago that we are underweight in some of the high growth coastal markets and overweight in the Midwest and some of the Chicago kind of lower performing markets. So over the last 2 years, we've aggressively acquired assets in Southern California, industrial assets in Southern California and New Jersey. And we've sold sub portfolios of our exposure in Chicago and industrial. And we're going to continue with that acquisition and disposition strategy until we hit near benchmark levels. And if you look at our kind of peer-to-peer performance, we've done well. A lot of our underperformance is because of the allocation challenge, and that's what we've been addressing and executing over the last 2 years. The office sector generally has been a detractor of performance for the benchmark as well as for TPF. We've made some successes in our NSA, clearly selling some of our big traditional office buildings, and we will continue to do so as we reduce our office exposure. And then on retail, you'll see this is the benefit of selling a lot of these regional shopping centers and closed shopping centers that were part of the NSA. We kind of got those out of the portfolio, and what we own in retail remaining, a lot of community lifestyle oriented shopping centers, those have done well, and we continue to like to own those assets going forward. So that's kind of a brief overview of the fund, of our sector performance, of our fund performance. And let me just pause there and see if there are any kind of specific questions about this slide or others that I covered.
And this is Gwelda Swilly with ANCO. Quick question. Where does your redemption queue stand at this point?
Sure. So I will move to slide number 49. And so what we have, if you could look on, it's called the capital flow slide. And if you could look on the left side of the page, our redemption pool as of early 2021 was 8.2 billion. We've paid out 3.1 billion. This is as of August 1st. And our balance is 7.3 billion as of August 1st. However, since that time, we made a redemption payment of about $200 million earlier this quarter. That's not included in this number. And then there's some movement on kind of appreciation that would probably alter that kind of current $7.3 billion balance. But I'll have to get kind of a more precise kind of point in time number for you to follow up on this call.
Is there a guesstimate of when that would be satisfied?
Yeah, so I will. The biggest driver of kind of redemption funding is through our sales plan,
right?
And it's kind of a very it's a lot of assumptions that go into a kind of our 3-year plan to eliminate the redemption pool that incorporates selling a certain amount of assets, kind of new redemption and rescissions. And investors rescinding their redemption request, and then there's kind of depreciation with the fund as well. So on the sales side, we have an aggressive sales target for 2022 We're in the market with a good amount of office, multifamily, and industrial product. But I will say that there is some disruption in the market. And as we go through our various stages of marketing these assets over the next 6 months, and the investment community, the capital market community starts to digest kind of higher interest rates and uncertainty around a recession, I think we'll have a little more color and clarity on our success with that sales plan. So I'd say right now we have a 3-year target horizon, but that's contingent on capital markets activity supporting us being able to execute sales without taking tremendous hits to market values.
Okay, thank you.
So at a very high level, can you give us just a quick bullet point or two on, again, if everybody that's in this fund is exposed to the current ongoing strategic properties and also the liquidating pool, if we look at other real estate funds, whenever they have to satisfy redemptions or move properties, it's not split up in pools like that. What was the rationale for doing that?
For
creating those two entities.
Yeah.
Jason, this
David?
is David. Let me make a comment, then you can build on it. Obviously, a couple of years ago, the fund performance had not been what it should be. And we went through the exercise of really sitting down and taking a hard look at the overall fund and, the properties, and coming up with, a set of assets that we really had high conviction in, and the remaining assets that, we didn't have as high conviction in. We had a substantial redemption pool. We wanted to kind of show our investors that, we're heading a new direction. We identified the properties we're going to sell. We came up with a sales plan. We're executing that plan. We've come a long ways. We still have a ways to go, but we came up with a strong game plan, and we've been executing on that. And the benefits are becoming to be more and more apparent every day. Jason?
Yeah, no, I think you hit it on the head. I think there's kind of no other secret solution besides separating these assets and doing a deep dive in the portfolio to look at how can we create a portfolio that will outperform the benchmark going forward. And a lot of the NSA assets were comprised of a majority of retail and office assets that we believed in 2020 would underperform, and we even more so have that conviction today. And I think we were happy with our execution starting in 2020, because end of 2020 and 2021 was such a receptive year to having assets in the market. Low interest rate environment, aggressive capital market buying on the debt and equity side. So we were able to dispose of many of our highly detracting assets in the portfolio on the office and retail side. And that led us to not only being able to fund redemption payments, but now creating a portfolio that is more reflective of kind of the low CapEx sector exposure that we're targeting. And to your point about other funds in the index and their redemption queues, I can't comment on. I will say that anybody in the market today is facing headwinds with kind of the cost of debt capital and the ability to liquidate at at appraised value or peak market pricing that we experienced in February of this year. So there is some disruption that is causing kind of a universal price discovery, if you will, that I think we're all kind of in the midst of evaluating. And that's also for us on the acquisition side as well.
Go ahead and move.
Anything else?
Did that answer your question, or is there any other questions I'm going to help answer?
Great, thank you.
Great. So Jason, thanks for joining us. I know you got to run. Good overview. You did take up way too much time though, but that's okay. We need it. With that having been said, why don't we switch back and take a look at the kind of research and strategy section of the presentation. First page of that is numbered page 7. And Francis, I'll let you hit the ground here running. And, we want to hear what you have to say, but, time is an issue. So please be judicious.
Okay, yeah, and thank you for the time. So hi, everyone. I am an economist on the research and strategy team. So given the timing, I will briefly provide a general overview of the real estate market, given current macroeconomic conditions. I'll then discuss major drivers across the 4 main property types. And then finally, I'll end with some ways we are positioning ourselves during this economic slowdown and high inflationary period. And some of this Jason already talked about, so I might go through that briefly. But feel free to ask me any questions either along the way or at the end of the presentation. So, well, the US economy has slowed and there are growing uncertainties around the outlook of the economy as well as the outlook of capital markets. The risk of a recession is increasing, and the 2 main drivers for this are the Fed potentially over tightening as they try to combat elevated levels of inflation, or high levels of inflation weighing on income, and as a result, slowing down consumption. If you look on the chart on the right, September CPI numbers eased very moderately, but remain elevated near record levels as supply chain bottlenecks and also high energy costs are putting significant pressure on prices. So if we move on to the next slide. So what does this mean for real estate? Well, for starters, entering real estate, into this period of economic uncertainty is poised for strong growth and is positioned for strength. Real estate returns are coming off record highs, primarily driven by residential and industrial returns. But with high debt costs, transaction activity has slowed. And the chart on the left is through Q2, but we expect to see even further decline when Q3 data gets released. So if we move on to the next slide, we'll see that in addition to the strong returns, market fundamentals in some markets remain strong. This chart gives a good depiction of the supply and demand factors that are driving occupancy levels. Property sector fundamentals remain exceptionally strong in the apartment and industrial sector. And across both sectors, occupancy rates are at record highs. However, we are forecasting some moderation in demand given the economic slowdown. And even with this, occupancy rates are expected to remain high over the next couple of years. Traditional office fundamentals are expected to continue to deteriorate until 2024 due to the work from home headwinds that we're seeing, while retail fundamentals are improving from pandemic disruptions. So if we move on to the next slide, we see a similar trend when it comes to rent growth. Having record levels of occupancy has allowed landlords to push rents even higher. So it's no surprise that apartment and industrial had abnormally high rent growth over the past year. But we do expect rent growth to moderate from record levels over the next 2 years. But office rents are very difficult to forecast because there's a growing delta between asking rents and effective rents, or in other words, asking rents and rents after concessions are taken into account. On the retail side, retail is actually rebounding from pandemic disruptions, and rents are expected to remain solid over the next 2 years. If we move on to the next slide, I will briefly go over some of the key drivers in each sector. So for residential, the US housing supply shortage is a strong tailwind that we expect will drive demand into the sector. Based on an analysis that Freddie Mac did, they estimated that rental homes are undersupplied by about 1 million units. And the total housing shortage overall, which includes for rent and for sale, is undersupplied by nearly 2 million units. In addition to this, or across product types, we are seeing stable fundamentals in garden-style apartment buildings, as Jason discussed earlier, while high-rise apartments, especially Class A, experienced significant volatility during the pandemic, but this gap between them are closing. Then if we move on to the next slide. So moving on to industrial, there has also been a big gap in market fundamentals and performance between Sunbelt and non-Sunbelt markets. Rent growth in Sunbelt markets surged as vacancy rates shifted towards record lows. And we expect, but we expect to see some convergence over the next 2 years as markets stabilize. In addition to this, a key demand driver for industrial is e-commerce, which continues to grow, but at a slower pace. Growth has softened from 2021's record level as the economy opened up again and stay-at-home orders are no longer impacting consumer behavior. But despite the slowdown, the current e-commerce penetration rate is actually near what it was initially forecasted to be prior to the pandemic. And this is according to eMarketer. So this softening is not necessarily alarming or surprising. And the general outlook for industrial continues to remain positive as other trends like reshoring or the federal support of semiconductors boost demand for the sector. Finally, we're also seeing a greater demand for industrial facilities that have a 31 plus foot clear height. And this is often in newer high quality products. High quality warehouse buildings tend to be more defensive during downturns or economic slowdowns because tenants generally with better credit are the ones renting the larger warehouse buildings with higher quality. So if we move on to office. So as we mentioned, or as I discussed earlier, office sector fundamentals are struggling for consistent and sustainable demand. Work from home is a major headwind. And as you can see, I am also at home right now. So, and workplace activity, which is shown on the left chart, is still below the pre-pandemic baseline. However, office jobs have rebounded from 2020's dip. And we're also seeing sustained growth among life science, which continue to grow throughout the pandemic. And this is a sector that we do like, and I'll touch on this slightly or briefly in a couple of slides. So moving on to retail, consumer spending, which is a key component of GDP, continues to grow even as consumer sentiment drops. Federal stimulus boosted the personal savings rate during the pandemic, but those savings rates are now below the historical average. And we are monitoring credit card usage as a sign of potential weakness to come. from the fundamental side of things, very low supply in the market has helped to improve the sector's fundamentals. There is limited supply in the pipeline, which reduces supply risk moving forward and puts retail at a better position in terms of occupancy. So if we move on to the next slide, without going into too much detail, we've identified 4 niche markets where the long-term fundamental outlook is strong. And as a result, we plan to increase our exposure into these markets moving forward. And this is where I cover life science and how it's a defensive sector, especially when it comes to jobs during downturns. So if we move on to the next slide. So finally, how can we position ourselves given the current economic slowdown, elevated inflation, but solid fundamentals in select sectors? The first is to tilt towards sectors or tenants with shorter lease terms in order to track closely with increasing prices. So that includes residential and self-storage. We're also seeing shorter lease agreements happen within the industrial space, even though industrial has traditionally been longer than residential and self-storage. The second is to tilt towards sectors with low CapEx, as Jason mentioned earlier. This again includes residential and self-storage. The office sector has the highest CapEx as a % of NOI. And so it is great that we are underweight office across all of our funds.
Can I jump in with a quick question, just because you do mention this CapEx spending as a major factor that you're looking at in your portfolio. Can you explain to us what that is, what capital expenditure is?
Sure. Yeah, so capital expenditure as a % of NOI is something or a metric that we look at mainly because, for example, in the office space, before a tenant moves into the office space, there needs to be significant expenditure to build out the space. Also the same with retail. There needs to be a lot of expenditure, which is usually on the landlord's expense to build out the space and to create a place that is suitable for the tenant. So sectors like residential or self-storage, there's not that big need to build out the space before a new tenant moves into the space. So CapEx is a risk because in periods of high inflation, prices are going up. And so the amount or the burden of capital expenditure on the landlord also increases. And so that's why it's good, especially during high inflationary periods, to, I guess, overweight sectors that have low CapEx.
So, okay, so just to clarify, is it fair to say that CapEx is something that we as investors have to spend and it cuts into our return or what we're getting from, it kind of offsets the rent that we get from people that we're renting our properties to?
Yeah, capital expenditures go into our general expenses. And so that feeds into our revenue. And so that is something that all landlords have to deal with.
Thank you.
But okay. And if there are no other questions, I can move on to the third point.
Please.
Okay, so the third point is to seek exposure to sectors that are less sensitive to GDP or GDP movement. Green Street recently published an analysis that shows how sensitive NOI or revenue is to change in GDP. And niche sectors were least sensitive, in particular senior housing, self-storage, and life science. So those sectors are great, and those are the sectors that we are increasing our exposure to. And finally, we are seeing a shift in migration towards affordability or affordable markets. So investing with affordability in mind will help capture more demand moving forward. So with that, I can open it up to questions or pass it back.
Francis, thank you for your thoughts. We appreciate the presentation, and I think we will now move on for a very quick firm overview and update review. And that is, it starts on presentation page 18. And this is David Lawson. I'm going to do the honors with regard to this section. I will move through them quickly. First page is just talking about UBS. Obviously, it's a big global financial services company. The kind of tree chart that lays across the bottom of the page kind of shows the divisions within UBS. And one of the main 4 divisions is asset management. Asset management has 6 divisions within itself. One of those divisions is real estate and private markets. And, real estate and private markets has 3 buckets underneath it, one of which is real estate, the others of which are infrastructure and multi-manager. So we obviously are in the real estate bucket. Hello? Yeah? I'm sorry, I didn't hear you.
Enseñarte algo.
I'm sorry, I still didn't pick that up.
Yeah, I don't know if that was a question.
I think somebody needs to be on mute.
Yeah.
Yeah.
Okay, I will continue on. Flipping over to page 19. Again, this is just kind of a quick view of UBS, but looking at real estate and private markets only. The top section of the page is talking about the global scope of real estate and private markets. And as you can see, a lot of big numbers operating in 14 countries. The Americas is 46% of it. So we're a big part of the overall real estate and private markets business. The lower section on the page looks at real estate and private markets in the U.S. And one of the largest managers of U.S. real estate, 186 employees, 711 investors, 450 investments. So, our U.S. operation in real estate and private markets, and specifically in real estate, is a substantial part of global asset management and is a important business segment for UBS. Looking at page 20, investment experience and mission, over 40 years of value-added real estate investment experience in the U.S., 29.4 billion assets under management. Third line, we have 186 employees and offices, and largest 2 offices are California and Connecticut, followed by Chicago, New York, and Texas. Next page is just a look at the real estate strategies we have in the U.S. And this is looking kind of across all our funds and separate accounts. You can see, we are spread out geographically with regard to our investments, assets by property type. We're highly diversified by property type. And then lower left-hand corner, assets by strategy. You can kind of see the way the business is broken up by strategy. And if you look at that donut chart, kind of on the right side of the donut chart, the 63% segment of the donut chart is Trumbull Property Fund. It's labeled open-ended core, but that is Trumbull Property Fund, and obviously represents 63% of the business and is, a big part of what we all do. On the left side of that donut chart, TPI is the kind of dark brown section and represents 11% of our business. And of course, TPI and TPF are the two funds in which you're invested. Looking at page 22, just a quick recap showing our U.S. direct real estate funds. We have 4 of them. The first 2 columns are TPI and TPF. Again, that's where you're invested. Jason just kind of gave us a great overview of TPF. And we're going to talk about TPI, and Chris is going to talk about that in just a couple of minutes. So I won't kind of go into that, but those are the 2 funds you're invested in. Next, page 23, in addition to our fund business, we do have a few individual accounts. And as you can see, we currently have 5. The vast majority are discretionary and, core and value-added real estate in those. Page 24 is kind of a history of UBS Realty, which is the name of the business here in the U.S. You can see that it originated as part of Aetna Realty Investors. In 1997, Aetna sold that business. It was acquired independently and operated under the name Legis Realty Investors for a few years. And in 2002 was acquired by UBS and brought into the UBS Real Estate and Private Markets business. And from 2002 to 2020, the business has grown appreciably, and you can see the numbers right there. So it's a kind of a long history group. We have a lot of accomplishments, and we appreciate the long-term relationship we have had with you. Next page is first one's talking about the real estate experience team, and we've got about 180 employees, and have a very unusual amount of kind of employee retention. A lot of people have, a lot of the employees have been with the company for many years. I personally have been with the company now for about 18 years, and getting to the point where I'm just now getting to the point where I'm not considered to be one of the new guys. So we have a lot of retention of great people over the years. It's a good place to work. Next page is really kind of talking about our firm and our employees and the fact that, we're a very multidisciplinary group. And, right there we have listed all the major kind of divisions within U.S. real estate. And it really kind of takes that network of people and network of experience and backgrounds in order to effectively do what we do. Next page, real estate asset management. Real estate asset management really is our business, and this kind of talks about a lot of the kind of blocking and tackling with regard to the business. The mission is to optimize cash flow and maximize investment value. And, we're doing kind of everything we can do with regard to the assets that we own, assets that we are selling, and assets that we are considering acquiring, is kind of looking at those, evaluating those, making decisions on which ones to buy, which ones to sell, and in the interim, how to get the most cash flow and return out of those assets. Next page is a list of the senior investment professionals. And, again, I said we have great employee retention. I will point out, I looked at this page earlier and came up with about 4 or 5 people who I would consider relatively new to the firm. And I guess that thought being with the firm 4 years or less. And of the senior investment professionals, the people I identified who've been with the firm 4 years or less are Matt Johnson, who's at the top left corner, head of real estate and private markets, Real Estate US. And Matt took over the business about 3 years ago. Prior to joining our group, he had been with the real estate and private markets multi-manager business. And he had done that and been extremely successful at it. And he came in and has really kind of invigorated our business and inspired a lot of kind of new thinking and insights. So he's been a great addition. About 6 lines down, head of Repham Real Estate U.S. Business Management and Operations is Amy White. Amy came in earlier this year, and she Matt, in addition to kind of looking at kind of strategic new ideas and acquisitions and growth areas, was also managing the overall business. And we really wanted him to focus on the growth areas and thinking ahead. And Amy has a background in managing real estate asset management firms and really looking at the management and operations side of it, making sure everything is streamlined and moving together in a coordinated fashion. So she's taking over a lot of what I'll call the blocking and tackling to give Matt time to, think more about strategy and direction. On the right-hand side of the page,
Excuse me. Hold on. We are really running. I mean, we've been in on almost an hour now. We would like to hear about TPI. So can you kind of go through this pretty quickly so we can get to the property income fund? Because
absolutely. So I will finish that page, page 28. We can go to page 29, and I will spend 1 minute on it. And, one of the questions was, why invest in private real estate? And we have 5 bullet points here that are really some of the primary reasons to invest in private real estate. And I'll read those. You can read them yourself as we go through them. Historically low correlations with equities and bonds, long-term performance, strong income return, lower volatility than stocks with periodic liquidity, and as a potential hedge against inflation. So those are some of the primary reasons to invest in private real estate. And with that completes this section. And I will hand it off to Chris Clayton, who's going to talk to us about Trumbull Property Income Fund, which is the other UBS Realty Fund that you are invested in and have been invested in it since 1984. Chris?
Okay, before I get started, I can see it's 5:35, and I just was wondering how much time you would want me to spend. I think we're almost through an hour, so I want to be aware of your time. Do I have maybe 2 minutes or 3, or so? That's a question.
Say, Jeff, I would say give him 10?
Yeah, I mean, I guess I would, number one, I would just say if the trustees are comfortable running over a bit, I think we're okay with that to get important information out there. And I can say from a time frame, what Welda and I have to discuss afterwards here, we can be brief. So we're happy to, I think from our end, if you want to go over, but we'll leave that to the trustees and their preferences.
Chris, can you do it in about 10 minutes?
Sure, I can try to cover this. I'll try to be done at 5:45 or so.
Okay.
Basically, let's move to slide 78 if we can. And this slide shows the portfolio management team. I work with Nolan Henry. I've been working on the fund for 17 years as the lead portfolio manager, and the portfolio manager reporting to the lead portfolio manager. And Nolan Henry has been working on the fund for 2 years. Moving to the next, so we have a lot of experience dedicated to the fund, I guess is the point. Moving to the next slide, you can see that Nolan and I are on the left, the portfolio team, and we have our dedicated asset management team on the right. And we changed the structure so that we now do have a dedicated asset management team, and they have a lot of outstanding experience working with working with borrowers and on participating mortgages. And they, Matt Wilson leads the group, and he does a terrific job. And it's very nice to have, you know, a single point of contact of a few people, as opposed to the way it used to be when asset managers were spread across funds throughout the organization, and TPI used to have about 16 asset managers working on the fund. So let's move to the next slide, and let me just make a couple points about, well, and then let's move to the next slide. That's some pictures of properties in the fund. I want to make a couple points just about the fund in general, and about TPI, and about the type of investments that we do. We make, first of all, the fund really offers a number of advantages in the current environment. First of all, we do offer some inflation protection, and I see my light just went out, which is great. And that's because of the participating mortgage structure. The participating mortgage is the primary investment in the fund, and it does share in property cash flows and value increases. So although it's a mortgage, it has equity characteristics, and that helps, you know, compared to other debt funds, which do not have any equity participation. TPI should perform better than those in an inflationary environment, which is obviously we're in right now. Also, over 80% of the investments are in sectors where the lease terms are relatively short, like apartments and select service hotels. Apartments have 1-year leases, and obviously hotels have one night or maybe up to a week leases or rents. So the point is, in an inflationary environment, the borrowers can raise rental rates relatively quickly in response to inflation for apartments and hotels, as opposed to sectors like office and retail, which may have longer term leases and where they will take longer to be able to respond to inflation. In this particular environment, also, we're finding some really good investment opportunities. We're finding that borrowers are interested in investing or in borrowing at fixed rates, because if they borrow at floating rates, they don't know what their cost of capital is going to be, because the rates are floating, and as interest rates keep going up, they don't know how much interest they're going to have to pay. So TPI offers fixed rate loans with a participation in the upside, and the participation only kicks in once the property's cash flow exceeds the expenses and interest payments on the property. So they have a better understanding of what their cost of capital is going to be for TPI as compared to, say, other debt funds. So it's a good environment right now for TPI to be finding new investments, and we're certainly seeing that right now. The one thing that everybody has been talking about is the low CapEx sectors, and TPI certainly agrees with that. About 2/3 of TPI's investments are in apartments, which are a low CapEx sector, because as as Francis was talking about, when a tenant vacates an apartment property, you may have to put down carpeting and paint the walls, but you won't have to tear down walls or build out new space like you might have to on an office or industrial property, where re-tenanting the space is going to require that type of work. And the last point I want to make, major point, is that TPI has no office properties, and in this particular environment, we are happy about that. I see that I've left myself about 3 minutes, which is okay. If we move to the next slide, this just talks about the participating mortgage structure in general and how it works. I've touched on some of the advantages of it, but a participating mortgage has characteristics of both a mortgage and an owned property. It's like a mortgage in that the mortgage receives interest over the life of the owner. The investor in the mortgage receives the interest over the life of the loan and the principal balance back at maturity. But it's like an owned property in that the investor shares in property cash flow in excess of the interest. So if the interest rate is 5% and the property is throwing off 6%, TPI would generally share, get 5.5% because we share 50-50 with the borrower. And so that's during the life of the loan. And then at maturity, TPI receives a preferred return, usually say in the range of 8 to 8.5%. So, and what that basically means is that TPI receives all the property cash flow from a sale or refinance up to an 8.5, looking back at all the cash flows it's received historically, up to an 8 or an 8.5% return. And this diagram here, it shows exactly how that works. It shows that over the life of the loan, and this is showing the property cash flows flowing down to the participating mortgage. During the life of the loan on the left, you can see TPI receives the mortgage interest, then any additional cash flow is shared 50-50 with the borrower. And then at maturity on the right, TPI receives the mortgage balance and then the minimum yield requirement, whatever it is, 8 or 8.5%. Then the borrower receives back its equity, and then any additional value is generally shared 50-50 with the borrower. So this is the participating mortgage structure. It's the primary investment in the fund. There are no other investment in, funds out there that invest primarily in participating mortgages like we do. And we think this is a good time to be invested in this fund at this particular point in the cycle. And I'll leave it there. I see it's 6:45. I said I'd stop. And if there's any questions, I'd be happy to answer them.
Is there a redemption queue for this fund?
Yes, there is. It's about $380 million.
Time frame? Do you, well, you're gonna be guessing. You're not sure, you'll be guesstimating, I guess.
Well, I can tell you that for the next 3 or 4 quarters, we're going to be making relatively low redemption payments because capital is constrained. So we wouldn't be expecting to pay down the pool, before, certainly in that time frame.
Okay, thank you.
Great. Any other questions from the trustees for UBS before we let them go?
None here. Thank you.
Thank you, guys.
Okay,
you,
great. Appreciate everyone's time and getting the whole group together to come in and go through this. Thank you.
Thank you very much.
Yes, thank you
Thanks
all.
for the opportunity.
Thank you.
Bye.
Yep, we really appreciate it. We're appreciate the the long-term relationship and always glad to do whatever we can. Thank you.
Great. Thanks, everyone.
All right. Have a good evening.
Bye.
They all off.
And looks like it. Yeah. Let's see. We got.
Jeff, do you want me to go ahead and kind of?
Yeah, apologies. For some reason I had it in my head that we were that we go till 6:30. So we probably shouldn't have let them run as long as we did. So we'll try to be, I think, Gwelda, if you can get us to like 5:55, I can probably take 5 minutes.
It won't take that long. It won't take that long. Okay, so we discussed UBS before with the committee, ANCO as a firm, our research division has put in basically a non-positive assessment of UBS, part of it being due to the fact that the redemption queues are so high. And with that being said, with current market conditions, it's going to take quite a while for them to come out of properties in order to satisfy those redemptions, even more so than it was a couple years ago because of the market conditions we're in now. So as a result, the research group pretty much is not going to follow it anymore. It's going to be on me and Jeff to keep an eye on UBS. I know you do not have a redemption request in now. And quite frankly, to put in a redemption request right now, we don't know when they'll be able to satisfy it, because what they have already, it's already at least 2 to 3 years, if not longer, to for the main fund, not for TPI. TPI is much smaller redemption queue. But so as a result of that, what Jeff and I've discussed is looking at your portfolio. You've already committed to some other real estate managers in the last quarter of last year. That was the recommendation from your prior consultant, and you've satisfied the first commitment, a request or capital calls. Going forward with UBS, take the money that they are throwing off in income or the distributions they give you, and use that for benefit payments and expenses, and not redeploy any more money into that. They are your 2 largest components in your real estate portion of the fund at this point, but not deploy any more money with UBS at this juncture, because as far as they've got a huge queue, that's why I was asking those questions during the presentation that they have from current investors to satisfy before you start seeing any positive upswing. Jeff, you have any additional comments with respect to that, or anything else we should say?
Yeah, I mean, I guess the only thing I would add on that, again, just from our firm's compliance standpoint, when our research group says the manager's not approved, and you need to tell your clients to look at replacing the manager, that we have to tell you that. And again, as Gwilda said, that's just that's real easy with an equity manager, because we can say, okay, it's we're telling you to swap this manager out. We can get this manager liquidated and give you a search and have this thing all wrapped up in a nice package in 30 days. But with this, we can tell you right now, yes, our research group doesn't recommend it. They're not following it. We're recommending people put in redemptions for this, or plans put redemptions in. But the reality is, if you were to put in a redemption for all of it today, it's going to be a long time. So again, to talk about magnitude of this, so they have $8 billion in redemptions, and the number they use in their report, they're showing you that they have 15 billion in the fund, but that's levered up. So, or I'm sorry, 18 billion. You strip out the leverage, what's actually equity capital, they're at about 15 billion. So more than half of what's coming out is more than half the fund is coming out, and that has grown significantly. I think even with these fee rebates, they're probably not going to get a lot of folks to stay in this thing. And again, he did not do a great job of answering my question of why they separated the funds the way they did. But I think the reality of that, it's legal, because if they kept everything together in one pot, and I think by their original documents and how they're written, that they could have investors come in and force them to sell good properties, stuff, right now it's a real good market for a certain amount of properties, but they want to keep that in an active fund. And I think part of that too is they can sort of use that as a marketing tool to say, well, the good pool that's not liquidating over here has had X performance, while the thing that's liquidating has had Y performance. But to us, it doesn't matter. We're getting exposed to all of it, and we will continue to be exposed to all of it as long as this thing's liquidating. So that's
Jeff.
Yes.
Hey, Jeff, is there any way, I mean, I've been asking the prior consultant as well for years to try to get out of this. And I don't think we ever were brought to a decision to take a vote to put in the redemption. And if we don't put one in now, even though we know it's going to take several years, we're delaying. The longer we do not put a redemption in, then we're just going to be at the bottom of the list every single time.
100%.
So why can't we take a vote to go ahead and submit the redemption and then utilize the income that's throwing off of this investment pool into cash for Sue to use? And then, we're going to just have to manage it that way until we find, but we've been talking about this for at least 4 years, and we're now, still at the bottom of the list.
And you can put the redemption request in. As we said, though, it's going to take several years to.
But if that's the way that if everybody is on board with that, then yes, the sooner you get in and make that vote and make that decision, whether it's 5 years, then it's better than 7 years if you wait another year. So I mean, that's just the nature of the beast of that investment. And again, because of that magnitude of 8 billion on 15 billion, that's going to take a while.
I mean, does anybody else have any comments on thoughts on that? Louis, are you on?
Yeah, I'm on. I concur with you, Chris, that maybe we need to take a vote on it now, and let's do what's the best for the fund going forward. Sue, what are your feelings on it?
Yeah, I think Sheila has a comment. So Sheila, if you're dialed in, just unmute your phone and you should be good. We should be able to hear you. Because your phone is on mute. But if you unmute that, we should be able to hear you.
Still can't hear her.
Yeah, she's still on mute.
Okay.
I guess also while Sheila's trying to get plugged in here, I do want to clarify something, and then and Gwilda, correct me if I'm wrong as well. But our research guidance on that was specific to the Trumbull Fund and not property income. So I guess you do have that decision of the magnitude of redemptions on property income is not the same. But there's the other factors of, as a firm, you have a lot of money coming out, you have a lot of turnover, you have all these other factors. So I think that's one thing. Do you say, do we do Trumbull Fund today and watch property income, or does it end up being in the same boat because it's the same firm? So, but again, our research guidance is a little bit different between the two funds.
Yeah, so I know that the Trumbull one is the one that we've been talking for years about getting out of.
Right.
The income one was still positive and generating good returns. And I'm sorry, the guy took so long, he lost me after, on his overview, that I didn't get to look at the returns, the recent returns.
I think they've been better.
Yeah,
yeah, they used to be better in the last. I mean, they were always, they were never negative. They were always a good rounding. Property income was always a good rounding one for our portfolios.
Right. So more recently, the Trumbull Fund has actually had the better performance, and I'll show everybody that when we pull up the flash report. But you have to, with a little bit of grain of salt, because it's not going to include the most recent quarterly performance. So if property income had a lot better performance than Trumbull Property Fund, that might skew it a little bit. But yes, the longer term return has been better on income, but more recently, Trumbull has been better.
If you want to look at that now, Jeff.
There we go.
Oops,
Oh,
sorry.
no, back one.
Yeah, I was gonna say, I missed it.
So you can see
Sheila,
oh, sorry, go ahead.
I'm sorry, Sheila texted me and said she'll bring it up at the general meeting. I guess she's having some technical difficulties.
Okay. So you can see that the 10-year and the inception number actually weight towards the income fund, but the near-term returns have been better. And you know, what that owes to, frankly, it could be it's structural sector weighting, some other issues, possibly you know, some of the leverage factor too. And but again, it's a different dynamic. Property income is definitely not going to be fighting the same amount of redemptions, but again, certainly you have to think about the overall firm issues. And when firms like this have a lot of redemptions for a flagship product, it does lead to people leaving, and we've seen that. So we've seen various reshufflings of that team over the past couple of years based on that factor. So.
So are we in agreement that we would just take a vote on it? Or where are we with this, Weldon, Christina, and Sue, and the rest of the trustees?
I would recommend it. We would recommend
Go
that you
ahead,
all make
Barbara.
a decision on the, at least on the TPF, as far as whether or not you want to put in a redemption request, but you know, as a formal vote from the group.
Okay. Chris, Susan, trustee,
I would just say anything we do at this meeting is a recommendation. And we would
exactly.
do it at Monday, you know, that we'd vote again at Monday's meeting, and that would be then the final decision.
So we need to get a motion now to
Yeah.
determine whether what we're gonna tell the full board, right?
Right.
Do you have a motion in order, Chris?
Well, I make a motion that we put a redemption in. Jeff, was your recommendation for both or just the Trumbull?
Was that a motion?
Jeff is on mute.
Okay.
I'm sorry, I apologize. I was
Hello?
talking and I was on mute. So I think at this point we would say the TPF Trumbull Property Fund, and then I think we probably have some additional time just because the queue's not as large to think about a strategy and just to see how the team is going to continue to hold up and the portfolio holds up for the income fund.
And would this be a full redemption request?
Yes, knowing that it would take time
Yeah.
to redeem. So I make a motion that we redeem Trumbull Properties through UBS. With the notion that it will take several years for the full redemption to be granted. Is there a second?
I second.
It's been properly moved and second. Any discussion? Sue, can we take a roll call vote?
Christina Bennett,
Yes.
Lewis Cross,
Sue, I can't hear you, Sue. I don't know what happened. I'm gonna go out and come back in.
okay.
Oh, Jesus. I can barely hear you all now.
We have Martell Mann,
Yes.
Bobby Richardson,
Yes.
and Albert Sanders. I think he might have dropped. And then Doris Walker.
Yes.
Sue, can you hear me?
I can hear you.
Okay, and I say yes. My phone, Sheila called me and I answered the phone, and when I come back, for some reason, this crazy phone my volume goes down to nothing.
Okay. No, we got you.
Okay,
So we have 5, so the motion carries.
Okay, Jeff, what's next on the agenda or Gwilda?
Well, Jeff's gonna give the, he's got the great honor of doing the performance this time.
I got lucky again because we're running short on time, so.
no Gwilda this time. No Jaws music.
So why don't we, hold on, let me just make sure I'm not on mute here. Okay, Sue, why don't we skip the first pages? I think we can talk a little bit about the markets when we're going through the rest of the report, but let's stop here and just focus on the asset allocation. So again, this won't be too much different from what we saw in the last report, that we are in compliance across pretty much all of the asset classes, with the exception of the hedge funds. And I just saw that Sue did get the redemption in for Grosvenor, and so that'll get once we get that money back. And again, that might take a couple months here, but once that's there, we'll be in compliance on the hedge fund portion of the equation. And again, that's what, when we go through performance, we'll also see that's sort of been skewed as well by overall market performance. So when everything else in the portfolio, like the equity managers and the fixed income managers, aren't doing as well, but the hedge funds are positive, that also skews it up a bit. So, but we do have the proper redemptions in place to get that back in line, and then everything else is in compliance. And again, just to refresh everyone's memory on how this chart works. So for each of the asset classes, the little black line that goes up and down, that's the target. The triangle is where the assets actually are, and then the bars are the allowable range. So what ideally everywhere we want to be within the allowable range, and certainly as we do cash flows and regular rebalancing, it's all designed to move all of those triangles closer to their center bars there. So again, from a compliance standpoint, looks good, and we'll knock on wood, and we'd like to see the markets help us out a little bit more, because they can do that. So when the equity markets start to get stronger and fixed income markets get stronger, that's going to push some of those things naturally back to their center bars as well. So and with that said, I'll sort of pre-talk about October. And again, I always hate talking about things on a day-to-day basis, but the markets have been a bit better in October. So it's been choppy, and we've had some good days, some bad days, but we've had some pretty more lumpy up days than downs in October. So far so good in October. And I think what everybody's looking at, and if we want to flip forward one page, Sue, and just take a look at numbers, and you can see where we were for September across the board on equities for this page, but another negative month in September, and really that continues to be driven by that inflation figure. So we still have inflation that's hovering above 8%. It did come in a little bit, but not as much as everybody would have liked, and that's caused the Federal Reserve and their policy, and remember what they do is they're changing the interest rates, or the money that gets charged to businesses and consumers and everybody else out there. That rate is going up, so it makes things more expensive for businesses to borrow money, for consumers to borrow money, for consumers to go out and get a mortgage. So, and the intention of that is to bring all prices of things down. So if people aren't spending as much because it's more expensive for them, then everything kind of naturally flows. But the long story short of that is that temporarily does not great things to the economy, and not great things to stock markets. But to put, I guess, if there's a positive spin on anything here, it's that the valuations for equities. And when I say valuations, that's how cheap something is relative to what we get at the end for being in it, for being in a company. Right now, it's fairly attractive, whether it's in the U.S. or outside of the U.S. And on the fixed income front, sort of a similar story in that as the Federal Reserve is going through this process of raising those interest rates, all of your bond managers can now go out into the market and swap their lower coupon bonds out now for bonds that have higher coupons. Well, again, in the short term, this goes against, or it temporarily hurts fixed income managers. But if we're not realizing those losses and we're holding things until maturity, then we actually get that better coupon yield over time. And again, that's been a big problem for pension funds over the last decade or so, that have significant amounts of money in their asset allocation in fixed income, but yet still have 7% or 7% plus return assumptions for their plan. You have a big chunk of the plan that's just not contributing well to that return. So what we're going to hopefully see over the coming decade now, because interest rates are higher, is that we're actually getting a better contribution from fixed income. Also add into that equities have now sold off quite a bit and valuations are good, that when we get a snapback, we're going to get a pretty healthy snapback and we capture that. So if there's good news in all of this, that's sort of one. And then the second is, again, if we just look at the top line for the month and the fiscal year and some of these other periods, we continue to be ahead of the policy. And again, that really speaks to some of the structuring of the fund. Recall, we've done some recent restructuring, did some things to de-risk and take a little bit of that risk off the table. And that was pretty timely because we've run into a fairly good chunk of a risky market. So, but also we have to give credit to some managers because many of them have continued to do pretty well. So I know we're still looking at negative numbers, but for a month it was pretty tough. And if you look at, Edgar Lomax is ahead of their benchmark. The value managers in general still did better than the growth managers. So, but all in, there was a pretty good offset. And again, recall that we started to move more towards the index as well. And that really hasn't played out as much on the shorter term basis, but we still expect going forward that's going to be, certainly that's going to be an area for us that is more consistency and takes out some of that volatility from some of these active managers. But the growth managers have continued to be hurt by those technology names, either the ones that they have been in that haven't done as well, or on the flip side, what's been a problem for some of these managers. And if you recall from the TCW discussion when they were in that, some of the names that they're not in or have been light on because valuations have gotten out of control and the benchmark weights are so high that they're temporarily underperforming. But again, we think those are the types of things that will reverse. So Sue, if you want to flip forward one page. Okay, and so again, the negative numbers in small cap, but as a group, the managers are ahead of the benchmark, so continuing to provide some protection on the downside. Again, it's hard it's hard to get too excited when it's still a negative number, but ultimately, when we do see that reversal, it really plays well into those long-term relative returns. And again, that's what we're looking for, is to get protected in these down markets and also participate nicely when we have those rebounds in the markets. Again, on the international equity side, for your both your developed and emerging managers, both ahead of their benchmarks. So again, protecting on the downside. So setting up nicely and should be in a good position when we rebound. Sue, if you want to go forward one more page. Again, similar situation with the global equity managers. So ahead of the benchmark, not by a ton, but still protecting that capital on the downside. And you can see from at least the sub-advisor standpoint, you have Foresight ahead for the month, Martin ahead for the month, Argo was off, and then Redwood ahead a little. So again, as a group, well positioned in protecting capital. And again, recall from our discussion at the last meeting on this construct that we really have a nice group of fully diversified managers that set us up to do that, to be well diversified and protect that capital. Sue, if you want to flip forward one more page. Fixed income managers, again, the relative outperformance isn't huge, and we're still looking at negative numbers for the core managers, but we're still in aggregate better than the market. So good downside protection. And on the opportunistic side, even more so. So you have that total universe down 5% for the month, and your managers as a group only down 4%. And then you can see the magnitude of some of those. Loomis doing much better than the group. They're only down 2%. The TIPS index, which is kind of surprising, because with the inflation numbers where they've been, we would think that that a TIPS manager, and those are Treasury inflation protected securities. Those are the securities that have income that actually adjust with inflation. But that can also be kind of telling when those numbers are negative like that. The market might be telling us, hey, we think inflation is going to start coming down, which again, that's good for everything. That's going to be good for the equities. That's going to be good for the fixed income in the portfolio. Neuberger on their global basis also ahead of their benchmark for the month, and your emerging market manager also well ahead of its benchmark. And Exponents continues to have some struggles with their portfolio. Again, some things that they have that are tied to different markets where liquidity is a bit more of a crunch for them. But again, remember, we made the decision to not increase that position until we can see more clarity from them, not only from the team because they've had that turnover with a portfolio manager, but also from that portfolio positioning. So fast forward one more page, Sue. And the global PIMCO's global asset fund was off a bit, so a little bit off the market. Some of that's going to be some commodity and currency positions and things that were a little bit more on the risky end of the spectrum. So that's they've continued to trail. But again, that's something that sets up nicely for when we see more of a reversal and more of a risk appetite come back to the market. And then the hedge funds, we talked about that before with why is that starting to become overweight within the portfolio? Well, it's been positive generally positive in a market. If you look over the 1 year period, relatively flat, but not down a lot like the other asset classes. So again, that's why we have these in the portfolio. They're not a huge position within the system, but they're at a size that they make a good diversifier and a good downside protector in these types of markets. Fast forward one more page, Sue, and we sort of already looked at this. So again, we don't have the real estate numbers, and those, and I think you heard from UBS, the numbers are starting to come in a bit from those real heady numbers that we've seen for the past several quarters, but still should be generally positive. So all of these asset classes you see on this page where we don't get the numbers every quarter, they are still additive, and once those do come in, should be adding to that overall total fund return. So I'll pause there. Sorry, I probably went a little bit longer than I promised. Questions, comments?
Well, the next month is going to be a toss-up to see who flips the coin.
Well, as the markets look right now, it should be positive. So we'll if nothing changes, then that's going to be Gwela's report.
I'll do the flash. You do the quarterly.
Okay.
I have no questions at the moment.
I don't have any.
Anyone else on the committee have any questions? What else do we have on the agenda, Gwela? Is that it?
I think that's it.
Gwela, before we wrap it, you just want to spend 2 seconds on the growth index?
Yeah, I was gonna wonder, do we want to do that at the quarterly meeting, or do we want to try to go into it now?
No. I mean, I don't think we want to get into it, other than
Okay.
Let everybody know that we have the surge.
Yeah, we did as instructed. We did put forth a request for a large cap growth index search, and we'll talk about that at the next meeting. we're looking at the two managers in tech and TCW, as you know, as Jeff mentioned, large cap growth has struggled, but there are also some concentration issues within the benchmark. And we'll go into more discussion of that at the meeting next month, the quarterly meeting next month. But we have
Okay.
completed the index fund search. And of course, and we did the S&P 500 also, but we were able to get some concessions on fees. So then we don't need to really address the S&P 500 index fund. And that's all we had for tonight.
And Gwilda, just to make sure, we, in all our searches, we are looking at majority and minority firms, right?
You're looking, yeah, for those, yeah, that have product, yes.
Okay, thank you.
Mhm.
Hearing none, Sue, at this point, do we call for a motion to adjourn?
That's correct.
Alrighty. Make a move that we adjourn. Is there a second?
Richardson, second.
Thanks, Bobby. All those in favor, please say aye. I don't think we need a roll call here.
Aye.
Right.
Aye.
Thanks, everyone, for attending tonight. I know it was long.
Okay.
I didn't expect UBS to go an hour and 15 minutes. Maybe if some feedback for them is to, you know, most managers are going to give you is 30 minutes. And so it was a tough one tonight.
Amen.
So I appreciate everyone's attention. All right, everybody, have a great weekend.
You
Bye.
too. See you all.
You too.
Thank you all.
Bye,
Take care.
everybody.
Okay. Bye-bye.
Thank you,
Bye-bye.
Jeff. Thank you, Gwilda.
Good night.
Thank you.
Okay.
Thank you.
Bye, Bobby. Bye, Sheila.